Tax-advantaged accounts. Tax-free stacks are faster racks. Screw taxes. Taxation is theft. An IncomeLuxe.com lesson. If you want to stack racks, you need a place to stack. Your tax-advantaged or brokerage accounts are the flip zones. Let's go over the main types of account you'll want to consider. 401k, Roth 401k, IRA, Roth IRA. Those are tax-advantaged. The following are not. Cash broker account, margin broker account, options account, futures account, and CFD accounts, offshore. The type of account will pretty much be based on capital limits, what you want to trade, and how you want to trade it. Tax-advantaged accounts, normal or Roth. Screw taxes. Dodge them when you can, but dodge them legally. Tax-advantaged accounts let you dodge them legally, but have crappy limitations that stop you from getting or using cash whenever you want. This seems like it sucks, but the entire point of these accounts is retirement. You're literally paying for the time period between work-life ending and your death. Unless you like being a crappy Walmart greeter at 70, put money into these accounts. You might want more than one. There's two main divisions in the type of tax-advantaged accounts, normal and Roth. Normal accounts, you make pre-tax contributions. You don't pay tax on the money you deposit in the account. But you do get tax-wrecked on the money you withdraw from the account in old age. That's paid at the income tax bracket, not the up to 20% lower capital gains rate. Roth accounts, you pay taxes on the contributions you put in the account. But you never get taxed on anything after that. Your money compounds until withdrawn completely tax-free, as long as you follow regulations on the account. If you plan on climbing the ladder and being in a higher income bracket than you are now, you should get a Roth 401k. If you're close to retirement, a Roth makes no sense. If far from retirement, a Roth makes more sense. Always use a calculator to see if you're going to get more bang for your buck out of Roth account or a normal account. Usually you get a big boost out of one or the other, but depends on your tax bracket, expected tax bracket, and current age. Here's one for you. Tax-advantaged account option 1, 401k, Roth 401k. 401k are made by your employer, which is pretty crappy because they have to choose to offer you one. Fortunately, they usually do, for full-time anyway, if only because everyone else you'd work for offers you one if you're good enough to get the job anyway. You can place an IRS capped amount of income in a 401k and you don't pay tax on it. You get to flip the hell out of it for the entirety of the time between your deposit and your withdrawal. Then you pay taxes on the amount you withdraw. The great thing, you literally get to flip money without slowing compounding by deducting taxes when you exit an investment. No 15% capital gains tax dragging your ass down. You also get matching. Your company will match whatever you're putting in that account up to a certain amount. My job. Each time I put in 6% of my income, they match the first 3% of my income dollar for dollar. For the second 3%, they put in 50 cents for each dollar. That's free money. Always take free money. You put in at least the matching. Above that, you should put in as much as you can, cause screw taxes, but at least that. Your options for investment are limited. You can only choose what they choose to offer you. I'll admit that sucks, but it's still tax-free. They typically are index funds, high-yield bonds, investment-grade bonds, large-cap equity funds, mid-size equity funds, small-cap funds, etc. 2 general rules about selections. All else equal, always select the lowest expense ratio in the category. That's the amount of money you invest that gets deducted as a fee for being in the investment. Make that as low as possible. More fees, less compounded. It's like a tax. And screw taxes. Make sure the investments don't overlap. This means the same investments in multiple funds. Avoid that. Lastly, the part that sucks. Really sucks. You can only ever withdraw money from the 401k under certain circumstances: disability, account owner death, or above age 59 and a half. Yeah, that sucks. But you'll be rich at the end of it. An IncomeLuxe.com lesson. Tax-advantaged account option 2, IRA, Roth IRA. Individual retirement accounts are government-sanctioned ways to save up buckets of cash tax-free for retirement. IRAs have several different breakdowns and can hold different investment options that aren't pre-approved by your employer's 401k options, because that sucks. There's multiple kinds too. You get normal IRAs, Roth IRAs, simple IRAs, SEP IRAs. You can set them all up through a brokerage. Normal and Roth IRAs are self-set up and self-directed. SEP and simple IRAs are set up by self-employers. Let's go over these no-tax paper chase options. Normal IRA. Normal IRAs are tax-deductible on contribution because screw taxes. If you put money in your IRA, the IRS lets you write it off as a deduction on your income. The IRS will not tax those earnings. If you withdraw it, they will tax the withdrawing at your ordinary income tax rate, which sucks. Deductibility depends on if your employer offers retirement plans, 401k. If they do, you'll be fully deductible only if you're under a certain income, around $60,000, depending on when you're reading this, see the rules from IRS below. If you earn more over that but under $73,000, it's only partially deductible. If over $73,000, not deductible. If you have no plan from your employer, all of them are deductible up to whatever the hell the annual limit is that year. It changes. After 70.5 years old, you are forced to take money out by the government so they can tax you. If you still don't take it out, they'll hit your saved up money with a massive 50% tax penalty. Screw that. Roth IRA. Roth IRAs are not tax deductible, but the qualified withdrawals are tax-free. You pay taxes on Roth contributions at your low income rate now, which should be lower than in the future, but zero income taxes on later. That's spectacular if you plan to climb the income ladder, cause you pay lower taxes now and none later. Also, if you don't withdraw any money there isn't a penalty, because they weren't taxing it anyway, so who cares? You can keep your money in there till 80 if you want. SEP IRA. If you're self-employed or own your own business, freelancing, independent contractor, small business owner, you can get a SEP, Simplified Employment Pension, IRA. Same tax rules at traditional IRA. Deposits are tax-free, withdrawals taxed at your future income rate, which still sucks ass. You can put up to 25% of your income or a dollar limit round $55,000, 2018, in the account. See rules for updates. Note that if you have employees and you set this up, you can contribute to their accounts, but they cannot contribute to their own accounts. You have to do it for them. Simple IRA. Simple IRAs are similar to SEP IRAs but with one major difference. Employees can actually contribute to their own plans. Employer is required to make contributions as well, just like a 401k. All of the contributions from employers and employees are tax deductible, so you can push yourself into a lower tax bracket just by contributions. Let's move on to brokerage accounts, both on and offshore. An IncomeLuxe.com lesson summary. Taxes are theft and slow your compounding. Legally dodge taxes whenever possible. Normal tax-advantaged accounts are taxed on withdrawal but not on deposit. Use normal if taxed at lower rate in the future versus now. Roth tax-advantaged accounts are taxed on deposit but not on withdrawal. Use Roth if taxed at higher rate in the future versus now. Always max the matching. It's free money. An IncomeLuxe.com lesson.